Hey, what's up guys, it's Jonathan here. Recently, the stock market has seen a lot of pain, with the S&P 500 down 8% since hitting its all-time highs in December, and Nasdaq down 14% from hitting its all-time highs in November. During times like this when the market is down, there's a couple of tips that I think are very helpful to investors during this time. So in this video, we're going to discuss 5 tips on investing in the stock market while it's on a downtrend. So if this video provides you any value, please consider hitting the like and subscribe button. It helps grow the channel, it helps push this video out to as many people as possible. So let's get right into it. So the first tip when it comes to investing in the stock market during a downtrend is to continue to keep buying into the market. This may seem very obvious, but it's actually very difficult for you to do this. When it comes to human psychology, most of the time when we see the price of stocks move up, we tend to think that our risk is decreasing as the price moves up. But then when the price of that stock starts to move down, we actually think the stock is more risky. When in reality, it's actually the opposite. When the price of stocks goes down and you're buying into it, you're actually lowering your risk. And this is because as the price moves down, it actually lowers your risk of loss. Then another thing about buying when the market's in a downtrend is that once the market starts to move to the upside, it can actually make your gains much greater in the long term. One thing that I should mention about this, especially for those of you who are buying individual stocks, is that it's very important that you understand the fundamentals of the stock that you're buying into. Because what can happen as well is that if you're buying into a stock that's on a downtrend, that stock may be on a downtrend because fundamentals in the business may have actually changed, causing the price of the stock to fall. Not necessarily the overall stock movement. It's just something that you should watch out for. So for me, I like to dollar cost average down during a downtrended market. So usually what I'll do is I'll get my cash and I may divvy it up to like maybe I'll spend X amount of money every week. And I'll say, let me just buy X amount of dollars every single day or X amount of dollars every single week worth of stocks. I'll just do this and dollar cost average all the way down. And you could do this whether you're investing in index funds or individual stocks. And if you want to get a little bit more sophisticated about it, you could set up recurring investments so you automatically buy over time. So if I ever end up in a situation where I run out of money and the market continues to decline, usually I'll then turn to margin. Pretty much what margin is when you borrow against your stocks. Kind of like if you had a house that had equity in it, you'd refinance your mortgage to take the equity out of the house. Margin is almost like the same thing for stocks, given that stocks are an asset. This actually leads me to my second tip, which is to avoid excess margin. Margin can be a very good tool to use when the market is declining, because if you do run out of cash, it allows you to be able to buy into the market and then worry about paying that margin off later on. Even though it can be a very helpful tool, you have to be careful with it because if the value of your stocks were to decline to a certain level, your brokerage has the right to do something called a margin call, where they may require you to pay back a certain portion of your loan immediately. And if you're not able to pay it back during that time frame, they may sell your stocks at the bottom of the market. And another thing with margin as well is that if you have too much margin outstanding, it may take your focus away from buying the dip and it'll move it over to you paying off the margin, which makes you miss a really great opportunity to add to your stock portfolio. So for me, I like to limit myself to no more than 3 months worth of margin. And what I mean by that is, let's say every month I'm investing $200 a month into the market. So in that situation, I wouldn't let myself get more than $600 into margin. So tip number 3 is to concentrate your portfolio. So this might sound a little bit confusing, so hear me out. So when a market is falling, typically the first stocks to fall are the most speculative. And those are usually things like cryptocurrencies, small and mid-cap stocks that don't have either revenues or profits. Those stocks usually get punished more versus mega caps like Amazon, Google, Tesla, Apple, those kind of companies. When the market reverses direction and starts to move to the upside, the more speculative assets tend to significantly outperform some of the mega caps. Given this and what we talked about earlier when it comes to risk and how when prices are falling, your risk is actually declining, this makes conditions for concentrating your portfolio much more favorable. So for me, what I like to do is I like to concentrate my position more into my favorite growth stocks when the market is going down. And something that I should mention when it comes to this, you should only concentrate into stocks or cryptos that you understand very well and that you believe will survive through the crash. If there's any possibility that a company may go bankrupt during this downtrend, you definitely don't want to concentrate into those positions. So this could be a pretty good strategy if you understand your investments very well. So tip number 4 I have is to save more aggressively. So like I said before, when the market is down, this is the best time to buy stocks. And when it comes to buying stocks, you're limited based on how much discretionary income you have. So to increase your discretionary income, you want to focus on trying to save as much money as possible. And this can be something as big as you canceling a car purchase that you're planning on making, to something as small as having date night at home versus going out and having date night at a restaurant. So really want to identify opportunities within your day-to-day life where you can save money so you can use that money to go and buy the dip. So tip number 5 is to figure out ways to make more money. I know that this can be a lot easier said than done, but you want to look for opportunities where you can increase your income, even if it's just slightly. Maybe you could go and ask your boss for a raise. You can maybe see if you could work some overtime. If you could possibly do a side hustle to make some money. Just small things like this. I'm not saying that you should try to 2x your income overnight. See if you can try and make a couple extra $100 a month so you can now use that money to go and buy the dip. So those are 5 tips for investing when the market's on a downtrend. It's very important as successful investors to think more about the long term and to not worry about what's happening in the short term. Use short-term pain as a catapult to much bigger gains in the future. So I'd like to thank you guys for watching. Also, if you made it this far through my videos, I'm pretty sure you're gonna like some of the other videos I post. So if you're interested, hit the subscribe button and notification bell. Also, let me know if you guys have some other tips for investing during rough times in the stock market. I'd love to hear from you guys. Check me out on all my socials. I've been posting a lot more short videos recently. So if you're interested, check me out there. And thank you so much for watching. I'll see you in the next video.